Assalamualaikum everyone. Good morning. Guys, please open ACCA practice platform. We will solve a latest past exam paper question on merger and acquisition. Please open ACCA practice platform. And open the latest exam paper. March-June 21. Please open the latest past exam paper question, March-June 21. This is available on ACCA practice platform. Please open this. Let's read the requirement first. So explain why our regulatory framework Mozam, you go to the AFM past paper. There is a link named ACCA practice platform. Click on that link, then log into my ACCA. It will take you to the ACCA practice platform. Click on the AFM, then click on the past exam paper, then assign the March-June 21 past paper. Okay. Okay, first question is, explain why a regulatory framework related to merger and acquisition is necessary to protect the interest of shareholder and other stakeholders. There are a number of reasons that why a regulatory framework is necessary for the protection of shareholders. I'm just highlighting the major reason. The number one reason is the regulatory framework is there to protect the right of minority shareholders. For example, if we are acquiring a target company Obviously, we need to acquire more than 50% shares in order to get the control of other company. What about those shareholders who have minority control, who have minority share? You will negotiate with the majority shareholder. You will pay higher price to the majority shareholder and you will get the control. And nobody, or you will not be bothered about the minority shareholder. So our regulatory framework is there to protect the rights of minority shareholders in a shape of minority mandatory bid rule and other types of rules. There is another reason regulatory framework is there to protect the shareholders in such a way that it instructs the management to act on behalf of shareholders. It instructs the directors to act on the behalf of shareholders. So there are reasons that why this regulatory framework is there. It protects the right of minority shareholders. It protects the right of target shareholders from its management. Sometimes when you try to acquire the other company, although your bid is very powerful, but the target company management blocks your bid. Target company management will not let the merger happen. Why? Because in case of merger and acquisition, their job can be lost. So regulatory framework is there to protect the shareholder from this against their own management. And certain other type of facilities is provided using this regulatory framework. For example, regulatory framework insists that sufficient time should be given to make the proper decision. The regulatory framework insists that the information flow between two parties should be transparent. So these are the benefits of regulatory framework. So that's why regulatory framework is there. So you need to discuss, you need to write a paragraph, one paragraph or two paragraph on the importance of regulatory framework. Regulatory framework is there to protect the right of shareholders, minority shareholders. It protects the right of shareholder against their own management. It gives you certain benefits, like regulatory framework insists that information should be transparent. The flow of information should be instant. If you are giving information, these information should be provided to all shareholders. If you are making a bid, you should give proper time to the other company to make informed and proper decision. So these are the benefits of regulatory framework, and you have to write this. And this theory is available in the notes in our merger and acquisition chapter. Second is discuss the two theoretical propositions as raised by company's board of directors in relation to a company capital structure. So there will be two propositions and you need to discuss few points on those propositions. Obviously, it will be cleared after reading the scenario. C part, prepare a report. Report will not include the first two parts. Report will only include the C part. Prepare a report for the board of directors of the company which estimates the value of each Kawa company share, K company share, if it is demerged and listed as independent company. Demerged means company will be separated from the main company and it will operate as an independent company. So it has 12 marks. Next is estimate the additional equity value created when combining this company and the Kawa company. So we need to calculate the combined market value. Additional value created when combining the companies. That means we need to calculate the combined market value. Then we will deduct the individual market values. Remember, when we deduct the individual market values from the combined market value, that is called the synergy. An examiner is asking about the synergy here. Additional equity value. We will deduct the individual equity values from the combined equity value. Then in next part, percentage gain to each acquirer and target company shareholders under each payment method, and the impact on the company capital structure under each payment method. So we need to calculate the gearing, that what will be the gearing under each payment method. Next is, this is part 1 and part 2 is all about the calculation, and report is actually on this part. The report is actually on this part. Evaluate the financial and other factors that both company shareholders and K company shareholder would consider prior to agreeing to this acquisition, and the impact on company's capital structure under each method. 11 marks are there. So let's read the scenario. It's a very long and detailed question. Okay. C company is a large listed company involved in 2 business sectors. Its main business is in the production of food and drink for supermarkets and other large traders. It also owns a chain of coffee shops nationwide. The board of directors thinks that company is undervalued and is of the opinion that it should focus on the rapid innovation taking place in the food and drink production sector. Therefore, company board has decided to unbundle. Unbundle means you are dividing your company into 2 parts, maybe more than 2, but here into 2 parts. Decided to unbundle the coffee shop business into company called Kawa Co. C company will then either demerge Kawa company through a spin-off or sell Kawa company. You have 2 choices. It has been decided that you will separate the coffee business, but now you will decide that either you have a choice to separate the coffee business into the Kawa business as a separate unit, or you can sell the coffee business to other company. Spin-off is a term in which you will separate your spin-off is a term in which you will separate your division from your existing business and make it a independent company, and its share will be owned by the previous shareholder. So you have 2 choices here. Next is, C company will then turn its full focus on its remaining business of food and drink. C company shareholder will own Kawa company on the basis of owning 1 Kawa company share for every C company share owned by them. So the number of shares will remain same. Okay, another company is this LAhla company is a large unlisted company controlled by 20 shareholders who all have a significant stake in the business. This company owns a number of hotels around the country and is looking to diversify into coffee retail business. So this company has approached C company about the possibility of purchasing Kawa Co. And this company will finance the purchase either through a cash only offer or a share for share offer. If a Kawa company is demerged, it will be listed on the stock exchange as an independent company. C company is unsure whether to sell Kawa company to L company or to demerge it on independent company. So there is a decision that whether you separate the coffee business into a Kawa company and you will own that company, or another decision is to sell the entire coffee business, entire Kawa business to the other company. So you have to take the decision. How we will take the decision? We will calculate the gain in both of the condition and decide on the basis of gain. If by selling as an individual company, if selling as an entire company is beneficial, we will write the decision that we should sell it to the other company. If making it a separate company, independent company, using a spin-off method, and we will own its share. If demerger is more feasible, we will advise to demerge. If selling the entire company is more feasible, we will give the conclusion that we should sell this company. So we have to take this decision. We have to do a lot of numerical work in C part. So let's read the next. You can close it. Areas for further clarification. Further clarification has been sought by L company board on the following two areas. CEO has determined that regulatory framework in the area of merger and acquisition is designed to protect the interest of shareholder and other stakeholders. She wants to find out why there is a need for regulatory framework. We have already discussed this part. The acquisition of Kawa company will be a major investment for L company, and its board has concern about how the acquisition will be financed. The board has heard that there are several theories explaining the capital structure of a company, including the following two propositions. Number one, company should maximize its debt financing. Number two, too much debt can be harmful to a company, and there need to be a balance between equity and debt. So guys, you will have to discuss these 2 points in requirement number 2. Please read the requirement number 2 and let's discuss this part. Read the requirement number 2. So let's discuss these proposition one by one. So this L company wants to acquire your company, and obviously they will need to arrange funds. You are the CEO of the company and someone has suggested you that company should maximize its debt finance. So you will write this, that company should arrange maximum loan, company should arrange maximum finance from the debt. As we know from the Modigliani and Miller theory, that arranging maximum finances from debt is cheaper because KD is cheaper. As KD is cheaper, it will reduce the overall WACC. As overall WACC will decrease, it will increase the company valuation, it will increase the company value. So a company should maximize its debt financing. You will prove this statement, that this statement is true, this statement is correct according to the theory. And if we follow this statement, it will increase the valuation of our company as WACC will decrease and overall company value will increase. Okay, this you will write this in the first paragraph. In second paragraph, you will write about this theory. This is too much debt can be harmful to a company, and therefore need to be a balance between equity and trade. This is a static trade-off theory. There is another theory that is static trade-off theory. This theory is in our notes of AFM. What is static trade-off theory? That is, company should raise new funds from the debt because debt is cheaper. Because of the debt, WACC will reduce and the company value will increase. But there is one issue. When you keep on increasing the debt, there will be a point at which your WACC will reduce to the minimum level. Beyond that level, your KD, your cost of equity, your WACC will start increasing. Because after raising certain level of debt, the company has to face a new cost, that is distress distress cost of interest. What is that? At higher level of debt, company will unable to get the new cheaper loan. At higher level of debt, company can raise the debt, but company will only be able to raise the debt at higher interest. At higher level of debt, shareholder will demand the extraordinary return from your company because your company will become extremely risky. At higher level of debt, your employees, your stakeholders like uh, supplier and customer will lose trust on you, and you will start losing the key employees, you will start losing the key customer and supplier. So too much debt can be harmful to the company. So according to this theory, you should raise debt because that is cheaper, but up to a certain level. After that certain level, debt will become harmful for the company. So you will explain these 2 points in 2 paragraphs. Both of these points are true. First point is according to the theory. Second point will actually the static trade-off theory. But if you don't know the name of theory, it is perfectly fine. This is a very common sense point that debt is cheaper, debt is beneficial, but up to certain point. After that point, debt will become expensive, that will become harmful for the company because after certain point, company has to face distress costs. Company will become extremely expensive and risky. So your employee, your customer, your supplier will lose trust on you, and you will start losing these key stakeholders. Okay. This is the answer of second point. Discuss the 2 theoretical proposition as raised by the board of directors in relation to the company capital structure. Guys, any question from the A and B part? Anyone? Okay, let's move to the next part. Yes, the extract from the company financial statement are as follows. Asset less current liabilities are 5010. Yes, it is okay if you don't write the name of the theory, but I think Modigliani and Miller theory, you can write the name of theory because theory is very common. And first point belongs to theory. Don't write the theory name in the second point, but you should write the name of the theory in the first point because we are studying theory since F9, right? So the first point from the theory. Asset less current liabilities are 5010. Share capital 1000. Number of share will be 2000. Reserves are given. Non-current liabilities. Loan note A is given. Loan note B is given. Company shares are trading at $2.5. And equity beta is 1.3. And Kawa company accounts for 24.5% of the total company. Company loan notes A currently has a total market value of 2100 million. Company loan notes B has a current market value of 400 million. Pre-tax KD is 4.3 for the A and 4.1 for the B. I think all the information are very important in this paragraph. After the unbundling, loan notes B will be serviced by the Kawa company and loan notes A will remain with the C company. but the pre-tax KD will increase by 0.3% for both of KDs. It is expected that Kawa company will maintain its capital structure after the unbundling. This statement is also very important. Company, this is the acquired company. This company debt equity ratio is 40-60 and it has 1200 million of share. The coffee retail industry is dominated by the B company, a large listed company, which owns many coffee shops around the world. Average asset beta is given. So this is a proxy company. So this one is a proxy company. All companies pay corporate tax 20% and tax is payable in the same year. Risk-free rate is 3% and the market risk premium is 7.2%. Okay, let's move to the next. Following estimated information will be applicable to Kawa company if it is demerged. C company sales revenue is 4,500 currently, of which 20% is attributable to Kawa company. It is estimated that after Kawa company is demerged, annual sales revenue growth will be 6% and the profit margin before interest and tax will be 21% for each of the next 4 years. It can be assumed that current taxable allowable depreciation will remain equivalent to the amount of investment needed to maintain the current level of operation. But Kawa company will require an additional investment in assets of $0.25 for every $1 rise in sales. I think this paragraph is pretty much similar to almost all of the past papers. There is nothing new information. After the initial 4 years, annual growth rate of the free cash flow is expected to be 2.5% of the foreseeable future. So this information is given to calculate the market value of Kawa company. Okay, now let's move to the last part. Following estimated information applies to the acquisition of Kawa company by L company if ever Kawa company is acquired. So this information is given from the perspective of an acquired company. If this L company acquires the Kawa Co, so from that perspective, this information is given. The average PE ratio of the hotel industry is 15.61. However, the L company PE ratio is estimated to be 10% lower than this. Okay. Extract from the current statement of profit and loss. L company profit and loss is given. Kawa company profit and loss is given. After the acquisition, it is expected that PE ratio of the combined company will be the midpoint between the individual company PE ratios. So combined PE ratio information is given. The annual after-tax profit will increase by 62 million due to the combining of the company. So guys, please identify that which method you will use to calculate the combined market value. Using which method you can calculate the combined market value. How you will calculate the combined market value? Can you identify? Earning based. Combined, we will calculate combined earnings, then we will multiply with the combined PE ratio, right? Perfect. L company has proposed to pay for the acquiring Kawa company either through a cash offer or for 1 L company share for 3 Kawa company shares. And company will borrow the money needed to pay for the acquisition. So for cash offer, this company needs to borrow from the market. So now you have read all the scenario. Guys, I'm requesting you that take your 5 minutes and please read the scenario again. Please read the requirements again. Take 5 minutes. Please read the scenario again please read all the requirements again. We have already discussed part A and B. Now we are going to solve the part C. But before starting with the solution, please take 5 minutes and read the scenario again, read all the requirements again. And when you read all the scenario and requirement, please write done in the chat box. Guys, please start reading. So let's open the spreadsheet. So first of all, we need to estimate the value of each Kawa company share if it is demerged and listed as an independent company. So we are solving first part of third requirement. First part of third requirement. Value of each Kawa company share if it is demerged and listed as independent company. So please open this. Obviously, you need a lot of information. So open as a split screen. Now, this is a part C and first requirement. That is value of Kawa company. Obviously, before calculating the value of the Kawa company, you need to calculate the cost of capital of the Kawa company. So let's calculate the cost of capital of the Kawa company. Once you're able to calculate the cost of capital of the Kawa company, then it will be easy to calculate the value of that company. Or you can start it using pro forma, and then you can solve the cost of capital. So let me start making a pro forma. If I open the next sheet, so we want to calculate the value of the Kawa company, make the dollar round off, dollar and million round off, years, 1, 2, 3, 4, 5 onwards. Now, the current sales revenue is 4,500, of which 20% is attributable to the Kawa company. So you can also make the pro forma of year 0, although you do not need it because market value is the present value of future cash flow. But obviously, you need this current value of revenue for the future calculation. So I'm making another year here, that is year 0. So currently sales is 4,500 into 20%. This is the current sale. Although you do not need this 900 for the calculation of the market value, because market value is the present value of future cash flow. But this column will help you to estimate the future column. So it is written here that annual sales revenue growth rate is 6%. So this revenue will increase by 6% every year. So this is the growth in revenue, and PBIT is 20%. PBIT is 21%. 21%. This is 21%. Then apply the tax. Tax is 20%. Tax information was on the previous exhibit. That is 20%. Tax is 20% minus 20%. Okay, next is Capex. And Capex is the change of sales, 25% of the change of sales, 0.25 for every $1 rise in sales. So first of all, you will calculate the change in sales. And then you will take its 25%. And the sum of all these will be free cash flows. Free cash flows. Now you need a discount rate to discount this. And you have to calculate that discount rate. So let's calculate the discount rate by putting working here. For discount rate, you need to open the previous exhibit. Can we use the C company beta 1.3? Guys, can we use this beta for the calculation of Kawa company WACC? Can we use this 1.3 beta? Anyone? Can we use the previous company beta 1.3 to calculate the market, to calculate the cost of capital of the Kawa company? Try to remember the first exhibit in which it was written that this C company is doing two businesses. This C company is doing food and drink and the coffee business. So if C company is doing two businesses, if C company is operating in two businesses, so now tell me, can you take this 1.3 as a beta for the Kawa company? If C company is operating in two businesses, can you use this 1.3 to value the Kawa company? No, you can't use, because this 1.3 beta includes the food and drink beta as well as the coffee beta. This is the combined beta. So you can't use the existing 1.3 beta. So please read the scenario and try to identify the Kawa company beta or the coffee beta or any beta which is related to coffee. Look, this 1.3 beta is the beta of the C company. This 1.3 beta is the beta of the C company. If this is the beta of C company, and C company, remember in the first exhibit, it was written that C company was operating in food and drink as well as coffee business. So this 1.3 includes both the risk of food and drink and coffee. So you can't use this beta to value the coffee business. So search the other business. This B company, Bunico, a large listed company which only operates in coffee. This 1.15 is the relevant beta here. So identify, it is assumed Uni company as proxy company will use its beta asset 1.15. Now, what is the market value? What is the market value of the Kawa? Market value of equity. Look, previously C company has 2000 shares and the share value is $2.45. And when it will become a Kawa company accounts for 24.5% of the C company total value. So first of all, calculate the market value of C company equity. And that is 2000 share that is please wait. $2,000 share into 2.45. So market value of C equity is 4,900. And what is the market value of Kawa company? It is 24.5%. 4,900 into 24.5%. Market value of equity of Kawa company is 1,200.5. Actually, first of all, calculate the number of shares of the C company. Nominal value is 0.5. Number of book value is 1000. That means number of shares are 2000, right? Number of shares are 2000. And the C company share price is $2.545. So first of all, calculate the C company total equity, that is 4,900. And Kawa company accounts for 24.5% of the C company value. So that should be equal to 1,200.5. Now, market value of debt. Market value of debt. This company has two types of debt, loan notes A and loan notes B. Please identify that which loan note belongs to Kawa company. Which loan notes belongs to Kawa company? Please identify. Loan note B. It is written here. After the unbundling, loan notes B will be serviced by the Kawa company. So its market value is equal to 400. Its market value is equal to 400. So now regear the beta asset using Kawa company gearing. Beta asset into market value of equity, beta asset into market value of equity plus market value of debt into 1 minus T divided by the equity value. So re-gear beta equity is 1.46. Please calculate. Beta equity is 1.46. Guys, please calculate and estimate the beta equity. Okay. Now please identify what is the risk-free rate. 3%. Risk premium is 7.2. Please calculate the cost of equity. K is equal to risk-free rate plus beta into risk premium. 13.49. So what is the KD? What is the KD of loan note B? KD of loan note B previously was 4.1. Now it will increase by 0.3%. KD was previously 4.1. Now it will increase by 0.3%. Take its after tax value. KD will be 3.52. So please calculate the WACC, market values. Write the market values. Write the cost of equity in front of it. Cost of equity is 13 point. Cost of debt is 3.52. Now let's calculate the WACC. Multiply it with its weight. Multiply it with its weight. And total is WACC will be 11%. WACC is 11%. WACC is 11%. Please check, guys. WACC is 11%. Now discount all these cash flows at 11%. And what is the growth of for the foreseeable future cash flows? What is the growth in future? 2.5%. $1.74 into 1.025 divided by 0.11 minus 0.025. Discount all these cash flows at 11%. 1.11 raised to power minus 1. Calculate the present value. The market value of business is $1,882. Please calculate. Guys, please estimate the answer. Okay. So if we recall, market value of equity is 1200. Previous market value of equity is 1200. Previous market value of debt is 400. So can you identify that how much debt is in the company? What is the proportion of debt in the company? Guys, please open the third exhibit and read this line. So can you tell me what is the meaning of this line? Anyone? This highlighted line. Can anyone explain? Capital structure will remain same. That capital structure will not change. So please identify that what is the capital structure of Kawa company? 1200 debt, 400 equity, 400 debt, 1200 equity. So that means debt will be 25% of the total capital, and equity will be 75%, right? Debt will be 25 and equity will be 75. Right? If I calculate equity is 1200 of 1600, that is 75, and debt is 400 of 1600, that means 25%. So this is the market value of business. This is market value of business. Now we calculate the market value of equity. That is 25% of the total value. So that means equity is 75% of the total business. Equity is 75% of the total business value. This is the market value of equity. This is the market value of equity. So before demerger, market value of equity was 1200.5, and after demerger, market value of equity is 1412. So can you calculate the gain? What is the gain in market value? Percentage gain is 17.63%. Percentage gain is 17.63%. So that is the gain in demerger. Before demerger, your value was approximately equal to 1200. Now your value is equal to 1412. Before demerger, your value was 1200. Market value of equity of Kawa is 1200. But when we do the demerger, now your value is equal to 1412. So what is the percentage gain? Take the difference of 1412 and 1200 and then divide it on the 1200. Answer will be approximately 18%. Okay. So that is a gain of demerger. So we have solved this part. Estimate the value of each Kawa company share if it is demerged and listed as independent company. Even you can calculate market value per share. Market value per share, as number of shares are 2000. So market value per share is 0.71. Market value per share is 0.71. So we have solved this part. This first part. Any question, guys? Any question? Please ask if there is any question. Otherwise, let's move to the next part. Sometimes we use only K in discount factor after cash flow, and sometimes use, look, whenever you use free cash flow to firm, discounted with WACC. Whenever you use free cash flow to equity, discounted with K. When you are deducting interest in the cash flows, that means these are free cash flow to equity, then discounted with K. If you are not deducting interest, that means these are free cash flow to firm, discounted with WACC. And sometimes company does not have any debt. If company does not have any debt, then you will also discount it with K, cost of equity. Okay. Next is estimate the additional value created when combining L company and Kawa company. So this will be part C and it will be second part. Additional value. What was the requirement? Additional equity value. Okay. Let's read it. P ratio of the industry is given and L company P ratio is 10% lower than this. P ratio of the industry is given and L company P ratio is 10% lower than this. So let's calculate the P ratio of PE ratio of L company. 15.61 into 0.9. Look, the P ratio of industry is 15.61 and L company P ratio is 10% lower than this. So P ratio of L company is 14.05 approximately. Okay, next is what is the P ratio of Kawa company? P ratio of Kawa company is given. How can we identify the P ratio of Kawa company? It is not given here, guys. Because it is stated that after acquisition, it is expected that P ratio of the combined company will be the midpoint between the two individual company P ratios. What is the meaning of this statement? That P ratio after acquisition will be the average of both of these the P ratio after acquisition will be the average of individual P ratios. So we have estimated the L company P ratio. Can you estimate the Kawa company P ratio? Guys, can you estimate the Kawa company P ratio? Any hint? How to identify the Kawa company P ratio? Anyone? Yes, market value over EPS. So, sir, P ratio of Kawa company is equal to market value of current market value. Current market value of equity. That was approximately 1200. And market value of debt. That was, sorry, earnings. Earnings of Kawa company. Earnings of Kawa company is given, that is 117.1. 117.1. And shares are, we can directly divide the market value with the earnings. 1200 over 17.1. 10.25. So now can you estimate the combined P ratio? Combined P ratio is, take the sum of these two and divide it with 2. This is the combined P ratio. Now calculate combined earnings. Combined earnings. First of all, calculate the earnings of what is the earning of L company? 171.0. 171. Kawa earning 117.1. Increase in earning. What is the increase in earning? 62 million. 62. So what is the combined earning? Sum 350.1. Combined earning is 350.1. Now calculate the combined market value. Combined earnings into combined P ratio. 4253. Now deduct the individual market values. Market value of company. Market value of Kawa company. Kawa company market value, we already knew that this is 1200.5. What is the market value of L company? L company P ratio is given. L company earnings are given. So we can calculate its market value by multiplying its earning with its P ratio. So additional equity is total minus this. So this will be 651. How to calculate incremental earning value? Incremental, you are saying incremental earning, increase in earning. This 62 is given in the question. This 62 is given in the question. Diya hua question. So this is the additional equity value. Okay, what is the next question? What is the next requirement? Next requirement is percentage gain to each company under each payment method. Percentage gain. So let's calculate the percentage gain. First of all, share method. Write the name of the company. Additional equity value means energy. How to calculate combined market value? I have multiplied combined earnings with the combined P ratio. I have multiplied combined earnings with the combined P ratio. Simple. Combined earnings with a combined P ratio. Okay, write the name of the company. Whenever you want to calculate percentage gain, you should follow this method. Write the name of the company write the name of both companies. Write the shares, market value per share, pre-acquisition value. Number of share of this company is given or not? Number of shares. Number of shares are not given. Number of shares are not given. So don't worry. Write the pre-acquisition value. Okay, write the pre-acquisition value, that is 2402. Write the pre-acquisition value of this company as well. This is pre-acquisition information. Pre-acquisition information. Now, write shares, market value per share, combined value, so write the combined value here. Okay, now you want to give one new share for every 3 share of Kawa company. Now you want to distribute one new share for every 3 share of Kawa company. One new share for every 3 share of Kawa company. Kawa company previous shares are 2000, right? And you want to give one new share for every 3 share of Kawa company. So this will be equal to 666. So you want to give 666.67 new shares to acquire the Kawa company. One new share for every 3 shares of the target company. So you want to distribute 666.67 new shares for 2000 shares of the target company. Okay. And actually, this is the combined value, right? This is the combined value. So now let's calculate the gain Now let's calculate the gain and loss to both of these companies. Guys, please calculate the number of shares to this L company. Is there any information given about the number of shares? Yes, information is given. 1200 shares, 1200 shares of L company. 1200 shares. So L company has 1200 shares. Look, whenever there is a question about gain and loss, write the previous shares of the combined company, write the previous market value of the combined company. You can skip this column, market value per share. There is no need to calculate this. And after acquisition, this 1200 you will put this 1200 straightforwardly here, because this L company is the acquirer. And remember one thing, acquired shares will remain same. So this 1200 will remain same. You will copy this here. And here you will issue, here you will write the new shares which you are going to issue. And it is stated in the question that, please read the second last line, that 1 L company share for every 3 Kawa company share. 1 L company share for every 3 Kawa company share. Okay, 1 new share for every 3 Kawa company share. How much Kawa company share previously? 2000. So we will be issuing 1 new share for every 3 share. So divide this 2000 with 3 multiplied with 1. It will be 666. Okay. So write the total number of shares. Now calculate the combined market value per share. Obviously, both of these shares belongs to the same company, the combined company. This will be same here. Combined value will be same. So please calculate the combined value. Now calculate the gain loss. Percentage gain. That is equal to divide this column. 2.28 is combined market value divided by the combined shares. Combined market value divided by the combined shares, 2.28. Both of these two shares belongs to combined company. So both of these shares has 2.28 value. Please calculate the gain. Gain is combined value deduct the individual value. And now calculate the percentage gain. That is 332 divide with this column, this value, previous value. $13.83 and 26.55. That's how you will calculate the combined value. So whenever there is a share for share exchange method, write the pre-acquisition information. This is pre-acquisition information. And this is post-acquisition information. Post-acquisition information. Okay, let me explain it all again. Let me fill this all again. First of all, write the L company number of shares, pre-acquisition information, that is 1200. Write the Kawa company number of shares, that is 2000. Write the pre-acquisition value of L company, that is 2402. Write the Kawa company number of shares, market value, that is 1200. Now, after acquisition, acquirer share will remain same. This will be 1200 here. Now, here you will write those shares which you are offering to acquire the Kawa company. Here, you will write those shares which you are offering to acquire the Kawa company. You are offering 3 new shares for you are offering 1 new share for every 3 shares. So 2000 divided by 3 into 1. Total number of shares are 1866. Write the combined value here. Combined value is 4253. You have the combined value, you have the combined shares, calculate the combined market value per share. This is 2.28. And obviously, both of these shares are the shares of combined company. So its value will also be equal to 2.28. Calculate the market value, combined market value by multiplying combined market value into number of shares. And then calculate the gain by deducting the combined value, post-acquisition value with the pre-acquisition value. And then calculate the gain by dividing the gain with the previous market value. Its gain is 13.83, it is 26.55. You can also write this post acquisition value. Okay. Now calculate the gain of cash method. First step is to copy all this information here. Copy all this. Now write the combined value. Sorry, write the pre-acquisition value first. Now you are not offering shares, you are offering cash. How much cash? Write the combined value, guys. How much cash you are offering? Please read from the scenario how much cash you are offering. 0.66 for every share of Kawa company. 0.66. So how much cash you are offering, guys? You're offering 0.66. 0.66 into 2000. You are offering 0.66 for every share of target company. So number of shares are? Number of shares are?
Yeah.
2000. So 4253 is the total value and you have offered 1320 to the other company. What is the value of the parent company or the acquirer? It will be the balancing figure. It is the balancing figure, 2933. So now calculate the gain. Gain will be deduct the combined post acquisition value with the pre-acquisition value. And then divide the gain with this value. Percentage gain is 12.12 and 9.95. That's how you will calculate the gain. Okay. We have solved other questions with this method, right? You guys are familiar with this method. It's not a new method. Any question? Please complete it. Any question? Any question, guys? First of all, whenever you want to solve the cash method, write the cash method heading. Completely copy the above calculation. Control C. Yes, we can solve the cash method or even the share method simply. It's not that difficult. But if you copy the above table, if you copy the above table, it will be much simpler to solve the cash method. Number of shares are already you have put the number of shares. Write the pre-acquisition value again, that is 2402, 1200. Now you are offering cash, so you will not write the number of shares here. Write the combined value here. How much cash you are offering? We are offering 0.66 into 2000. So combined value is 4253. We are offering cash 1320. So what is that remaining value? That remaining value will be left for the acquirer. So simply, rest of the calculation is will be done automatically. Market value of L company calculated by multiplying P ratio with the earnings. By multiplying P ratio with the earnings. Okay, guys. Any question? Now there is another requirement. Impact on the company's capital structure under each payment method. Impact on the company's capital structure. So let's calculate. Capital structure. So let's calculate the current capital structure. What is the equity value of this company? 2402. And what is the debt of this company? What is the debt of this company? It must be given in the question. 40-60. 40% debt and 60% is equity. So that is 40%. If that is 40%, and that means if this is equity, this will be 60%. So what will be the 40% value? If this 2402 is the 60%, what should be the 40% value? 1601. And total will be 403. So in terms of percentage, it will be 60. And in terms of percentage, it will be 40%. This will be a current capital structure. Okay. Okay, now let's write the capital structure in case of cash offer. Cash offer. So what is the equity value? What is the equity value now? Please identify what is the equity value in case of cash offer. $2933. $2933, right? This is the market value of equity of L company. And what is the debt value? What is the debt value? Guys, if we acquire the other company, what should be our debt value? Anyone, can you explain? Can you identify? What should be the debt value? Obviously, now, after acquisition, you have become a combined company. Remember this thing. After acquisition, now you have become a combined company. This is after acquisition. And after acquisition means you must have previous debt. plus you have the debt of the Kawa company. Remember the debt of Kawa company has a value of 400, plus you will also raise this cash from the market, 1320, because you need to give this cash to the other company. So the total debt will be 3321. Total debt will be 3321. How I have calculated this 3321? First of all, in cash offer, what will be the combined equity? In cash offer, we have given the cash to the other company and our equity will be 2933. 2933. What is the debt? This is the debt of the combined business. First of all, write the debt of L company, add the debt of Kawa company, plus add that cash which you are giving to the other company because you need to raise that cash from the market. So add this 1320. So the total debt is 3321. So it will be 53% and 46.9%. Okay. Now in case of share offer, what is the combined value in case of share offer? Guys, can you identify what is the combined value of equity in case of share offer? What is the combined value of equity in case of share offer? Should I take 2734 or 4253? In case of share offer, should I take 2734 or 4253? Do think before answering. 4253, because in share offer, both of these shares, both of these values belongs to the same company. So write 4253. And what about the debt? What is the combined debt? What should be the combined debt? It will be the previous debt of the L company plus the debt of Kawa company. Should I add something more or these two figures are enough? Whether we should raise new debt or not in this case. In case of share for share exchange, should we raise the new funds? No. So what is the total capital structure? So calculate the weight of, you can also copy these two percentages here. 68% and 32%. And now you have to write the report. Let's discuss from the Kawa company perspective. If we do not sell and only demerger the Kawa company gain is approximately 18%. If we do not demerger, if we do not sell in the market and only do the demerger, our gain is 17.63. So I'm talking about from the Kawa company perspective. Kawa. if demerger, gain is 17.63%. In case of sell, there are two methods: share offer, cash offer. In case of share offer, gain is 26%. In case of cash offer, gain is 9.9%. Okay. Now this is the discussion according to the L company perspective. In case of share offer, its gain is 13.83. And in case of share for share, it's 9.95. So please tell me, from the Kawa perspective, what should you do? Demerger or sell? What should you do? Demerger or sell? Obviously, you have to write in the report in a very detailed form, but in a very simple way, I'm explaining that demerger is beneficial for the Kawa company if in comparison with the cash offer. Demerger is beneficial. You will make independent company. The ownership will remain with the existing company shareholders, and there is a gain in a price that is 17.63. Obviously, you have to list your company independently, and your company value will increase by 17.63%. But in case of sell, share offer is lucrative. In case of share offer, there is a gain of 26.55%. 26.55%. So this share offer is gain is much more compared to the demerger. If L company, there is one problem with the L company. Let me discuss that. If L company is a market-based company and L company shares are tradable in the market, then its gain is 26.55. But the problem with this gain is this is a share for share method gain. This is not certain, and you can only rely on this figure if future estimates or the future value or the combined value is going to be certain, and you can achieve this. Otherwise, obviously, we know that share for share offer gain is uncertain. So if we only consider the percentages, share offer is lucrative and higher. Demerger case is beneficial only in comparison with the cash offer. Share offer is overall beneficial, but the problem with the share offer is this is not a certain gain. This is uncertain. It depends upon the estimates according to which you have calculated the value. So companies should apply scenario analysis and the sensitivity analysis to judge the accuracy of these figures. And if we discuss about from the perspective of L company shareholders, they are more beneficial in case of share offer, but cash offer is still, I think I have written a wrong one. Cash offer is, this is 22%. From the perspective of L company shareholders, cash offer is much more beneficial. They will get the 22%. They will get the share of 22%. And this is This is much higher than the share offer where they will get only 13.83%. But the problem with this cash offer is in cash offer, your gearing will increase to 53% from 40% to 53%. Although cash offer is lucrative, although the cash offer gain is very high, but L company shareholders should consider this point that its gearing will increase to 53%. Although the gain in case of share offer is lower, but in case of share offer, your gearing will reduce to 32%. So you will also need to discuss these gain and these percentage gain according to the risk of the company, that is the gearing. So if L company wants to issue, wants to adopt the cash method and other company agrees to it, the problem which L company will face in future, that is it will trap in a higher level of debt. However, in case of share offer, they do not need to borrow from the market and their gearing will reduce to 32%. So that's how you will discuss this part in report format and in this method, in this requirement. Okay. So one paragraph for the Kawa company shareholders, one paragraph of discussion for the L company shareholders, and other paragraph from the capital structure perspective. And obviously you will also write that you have taken certain assumption in order to calculate these estimates. So it was a very, very comprehensive question. Any question, guys? You need to discuss, you need to write the, you need to read the answer of this question. Any question? Guys, guys, there was another problem with this acquirer. You know, this acquirer was, can you identify that why market value of L company is not given in the question? There is a reason. This L company is not a listed company. This L company is not a listed company. Please read this. The average PE ratio of the industry is 15.61, but your PE ratio is 10% lower than this. And market value of this company is not given. So this L company is an unlisted company. This L company is an unlisted company. Even the share of share for share offer is lucrative. What you will do if you get the shares of unlisted company? For example, if I acquire your company and my shares are unlisted, what you will do by taking share of my company? You can't sell unlisted company shares in the market. Either this L company should list its share in the market. Otherwise, demerger is beneficial in this case. So you have to write in every perspective. First of all, you will write this that 17.6% is greater than the cash offer. So company should consider the demerger offer. But the share offer is lucrative. In the share offer, we are getting the gain of 26.55%. And then you will write another paragraph and you will write according to this L company perspective. L company shareholder will get a gain of 13% in case of share offer. L company shareholders will get a gain of 22% in case of cash offer. But if they insist on cash offer, they should also consider that there is a very high risk of cash offer, and that is increase of gearing, and that will be 53%. Now gearing will move to 53%. Share for share offer, although the gain of share for share offer is lower, but in case of share for share offer, company gearing will only be 32%. So L company will preferably move to share offer. Why? Because of its less risky nature. And this share for share offer is although very lucrative to the Kawa company. But the problem with the share offer is that L company is an unlisted company, and Kawa company will not be ready to get the unlisted shares. Why? Because you can't sell those unlisted shares in the market. So there can be two choices now. First one is L company should list its share in the market and should make the shares public so that Kawa company can sell it in the market. And second one is Kawa company should decline the share offer and should choose one between demerger and cash offer, and that is demerger. So its discussion is also complex. Now please ask question. So in report writing, what you have to discuss, there is a clear requirement that evaluates the financial and other factors that both L company and Kawa company shareholder would consider prior to agreeing to the acquisition, and the impact of company capital structure under each payment method. So your first paragraph should be from the Kawa perspective. The second paragraph should be on the L company perspective, and your third paragraph should be on the capital structure impact. And that is very simple. Obviously, gearing will increase in case of cash offer, gearing will decrease in case of share offer. Although, then you will write, although cash offer is lucrative here, but L company will go for the share offer because in case of share offer is less risky because gearing will decrease. Then you will write that although share offer is lucrative from the Kawa company perspective, but Kawa company should consider this should take into account this point that they will get the unlisted company shares. They will not be able to sell those shares in the market. So what is the solution? First solution is they will request to the L company that they should do the listing of the shares. They will ask the L company that go for public listing of the company. But second point is instead of accepting share offer, they should go for the demerger offer. There they will get 17.63% gain. And then you will make the conclusion. Okay. Read the examiner answer, but write the answer in your own words. Any question? So guys, this was a very comprehensive question. We will try to solve two questions on tomorrow. One of the student has requested the name of one question. If you have any name in your mind, so you can also request me in the WhatsApp group. Any question, guys? And do read the answer of examiner. Please, it's a request. Do read the answer of examiner. No question. So I am ending the session. Okay. Okay. I will share the answer, but the problem is when I copy this into the Excel sheet, formulas cannot be copied. Figures will be there, but formulas cannot be copied. Tomorrow's topic is same, merger and restructuring. Merger and restructuring. Okay, guys, take care. Recording will be available. Don't worry, recording will be available. Take care, guys. Allah Hafiz, everyone.